So this is class 4. Today what we want to do is get into one of my favorite topics, which is fixed income. We'll talk about cash and cash equivalents first, and then we'll get into fixed income. We'll talk about this mnemonic I have, a DC cuts I, and we'll get into hopefully the first two of those, duration, which is the D of DC, and convexity, the C. So let's start with cash and cash equivalents. So with cash, this comes from page 6 of the class notes. There's only one asset class for cash. We don't have sub-asset classes for cash. In fact, a lot of models don't even have cash listed as an asset class. Just depends on their theory. Cash is sometimes just, no one really allocates the cash. It's just something that's there in case they want some liquidity. But cash is loans to corporations and governments, but that mature in less than 1 year. So examples of those would be Treasury bills. So you know with Treasuries, there are Treasury bills, Treasury notes, and Treasury bonds. I don't think there's a big deal making the distinction between bonds and notes. But Treasury bills, anytime you see the word bills, that means the very short-term debt that the U.S. government has. So when the government borrows short-term, the Treasury bills, they are discount bonds. What a discount bond means is you don't pay an interest, you don't pay coupon. Instead, you buy the bond for one price, and then it matures at a higher price. So you might buy it for 97, and then it matures at 100. And so your entire return is a change in the price. Not only do governments borrow money, but agencies have short-term loans. So U.S. government agencies. And then there are corporations. When corporations borrow short-term, we use the term commercial paper. Commercial paper tends to be a very high quality type of debt. Corporations can borrow money short-term from banks, but those are not part of our list of securities because they're not traded on the markets. So commercial paper is when high quality corporations like a UTSA, like Exxon, when they borrow money through commercial paper when they need a short-term amount of funding. So those are the typical types of short-term securities. When you bundle all these together into one portfolio, it's called a money market account. You could have a money market checking account, a money market savings account. You could have certificates of deposit that banks offer that could be related to the money market. You have money market demand accounts that banks provide, or money market mutual funds, which the mutual fund industry provides. What these are is banks, investment firms putting together a collection of these types of securities into one account and paying you an overall rate. So banks, they may be loaning money for auto loans and home equity loans, and then they're paying out on checking and savings accounts. So you're essentially getting a rate that's based on what their loan portfolio looks like. So money market accounts, these money market mutual funds, they buy commercial paper, they buy discount notes, and other types of securities. Now in 2008, it's very rare for money market mutual funds to actually have problems. They usually trade exactly for $1, and then you just make the interest. That's why I say, you know, short-term cash has very low price risk, because when you buy a money market mutual fund, the price is almost always exactly $1, and they just pay you interest throughout the year. 2008 was a little different, where we had a mutual fund, in fact one of the largest and oldest mutual funds that does money market that's out there, and they actually did what we call break the buck, which means it fell below $1. And it fell below the dollar because of its exposure to Lehman Brothers and probably to AIG and some others. Now, it did not fall much. It fell from like $1 to 97 cents, but the markets freaked out. Everybody started getting really worried about their money market mutual funds, that they were going to lose. You're just not supposed to lose money. You know, you think it would have been so bad to lose 3% when the stock market's down 30, 40, 50%. But people still freaked out. The U.S. government had to step in and backstop these money market mutual funds. And the government probably made money on that program, because I don't think they ever paid any money out to protect people from losses. But they did make a lot of money from mutual funds who joined the program. So we generally think of these as very, very, very low risk securities. So their expected return is generally very, very, very low. We generally think of them having low risk because they have low volatility. Their prices really don't change at all. They stay the exact same price. The risk you have with cash is inflation risk and reinvestment risk. We already talked about reinvestment risk last class, and that is that they're very sensitive to changes in interest rates. When interest rates fall, their returns fall right along with it. Historically, cash type of investments have not kept up with inflation, so you actually made what we call a negative real return. When you take a return, subtract inflation, cash has really not done well. We'll talk about duration. Duration of cash is essentially zero. What that means is duration tells you how much price risk you have or how much interest rate you have. So if your price risk or interest rate risk is very low, close to zero, then your duration is zero. They do have high reinvestment risk. The credit risk, that's the risk of bankruptcy or what they invest in going under, is very, very, very low. But as I mentioned, in 2008, there were some credit losses in these portfolios. Generally, commercial paper is very high quality, but AIG, Lehman Brothers, when the markets get scared, they don't want to loan you money, and you have a lot of commercial paper that you need to roll over continuously, hundreds of millions of dollars. If you don't have the trust of markets, about your only solution is to go bankrupt because you cannot pay the bills. Their correlation changes over time, but usually in a crisis, they usually do pretty well. They don't have really high returns, but they don't lose money usually either. So you think about it, in 2008 was the worst case scenario for cash and money market mutual funds. There were some small losses in a few of those funds, but very small, 1 or 2, 3% at the most. So even in a worst case scenario, they don't lose much money. Generally cash, that's why I say cash is not always an asset class for everybody. Generally, cash is what you hold to help your liquidity, to make sure you have cash when you need it in case one of your clients needs money out of the portfolio and you have liquidity built to fund that withdrawal, or it's just a holding place. So you're not necessarily investing in cash, you're just holding in cash until some good opportunity comes along. You might have heard the term keep one's powder dry, which means don't shoot all your bullets. Wait for the market to really crash, some opportunities. So you have some cash sitting in your portfolio, you can go out and invest and be able to take advantage of those opportunities. So let's talk about bonds. So bonds, we have 7 things we're going to talk about bonds. DC cuts I is a mnemonic or acronym or whatever you want to call it that we've come up with. Really, I think a mnemonic. D is for duration. We'll talk about that first. The first C is for convexity. We'll get into convexity today. Hopefully we'll finish convexity today. The second C is credit. The U is what we talked about last class, is U.S. versus non-U.S. bonds. So there are some people who classify non-U.S. bonds under bonds. Other people have that as alternatives. We'll talk about non-U.S. bonds here. T is for taxes. Bonds have different types of tax treatment depending on the type of the bond. S is the cool one. It's structure. It's actually becoming the most important one. It definitely had a huge impact on 2008, so we'll talk about structure. And then the I is inflation. We now have inflation-linked bonds that help protect us from inflation, so we have I as a separate one. I've talked to a lot of people in fixed income to try to see, is there anything else we should add to this list? And to date, I have not gotten anyone to add anything else. I would learn that list. Can you say it back? Take a second. Can you remember what all these stand for? I'll give them to you one more time and just see if you can remember it. D for duration, C for convexity, C for credit, U for U.S. versus non-U.S., T for taxes, S for structure. Make sure you notice the word structure. Some people just make up a word starting with S, but structure, and we'll talk about that. And I for inflation. Permanently memorize this list. It will help you tremendously. If a question comes up about bonds or fixed income in an interview, if you know this list, DC cuts I, you will give a better answer than 99% of undergraduate students. So it's a great thing to just keep. I'm trying to give you some quick ways to remember things that make you sound really impressive in interviews. So now the key is that we understand them. So let's get into them. So pages 6 and 7 of the notes, we'll talk about duration. It's also related to maturity. Maturity, you probably have heard that term. That's when a bond matures. So if you loan someone $1,000 for 10 years, they pay you interest, and then at the end of the 10 years, they pay you back the principal. That's the maturity of the bond. So the maturity is 10 years. However, the fixed income world likes duration better. It's a better, more effective measure of the risk of bonds. So let's talk about, so remember what we've got to do here, and you got to keep this in mind with every one of these on DC Cuts I. You want to be able to define it. So we're going to define it here. You want to know the subcategories. So here are the subcategories. And then you want to talk about the strategy. So on the next few slides, we'll talk strategy as well. So I'm going to skip it a little out of order. Let's first talk about the definition. What is duration? So technically, the definition of duration is the weighted average time to maturity. There's that word maturity, but it's the weighted average time to maturity using discounted cash flows as the weights. So it includes both interest and principal. You remember we said for the maturity value, that only looks at the principal. But duration looks at both principal and interest. So if a bond is paying interest over the next 10 years, their duration will be shorter than maturity because some of the cash flows are coming before maturity. And so the average maturity might be 8 years for a 10-year bond. So the maturity might be 10 years, but the duration may be 8 years because they're paying you cash flow throughout the 10 years. I'm going to later, we are going to price a bond, and I will actually show you the formula for duration. So you can actually see how it works. It's actually a very simple formula. You probably already know how to do this. You should have done it in your first finance class. We'll do it again in this class. I'll assume you've forgotten all of that. That formula you should have learned, unless you use a calculator. If you use a calculator, I'll have to unteach you on that and show you how to really do it in Excel. Because if you actually price a bond in Excel, you can calculate duration very quickly using that exact same framework. So duration, another way to talk about duration, there's a technical definition. It's the weighted average time to maturity. So what are your weights? You use the discounted cash flows. But a more generic definition of duration is a measure of price risk or of interest rate risk. Interest rate risk and price risk are very similar things. So the interest rate risk, the price risk of a bond. So what do we mean? How sensitive is the price of the bond to changes? That's the key, changes in interest rates. And here's a formula we can actually use. And on the exam, I'd recommend you put this formula in and maybe give an example. I'll give you an example on the next page, but give an example. So here's a very famous formula in finance. And I'll just tell you right now that everybody expects you, when you interview for a job, everybody in finance would expect you to know this formula. This is one of those most famous formulas in finance. So what does it say? You take minus duration times the change in interest rates or the change in yield. Why minus? Well, because bonds generally, especially if a bond has a positive duration, when interest rates rise, bond prices fall. So we have to use a minus sign because there is an inverse relationship between the prices of bonds and interest rates. So minus duration times the change in interest rates. Remember with cash, we said cash essentially has a duration of 0. So for cash, you do minus 0 times the change in yields, you get 0, so there is no impact. So cash has no price risk, no interest rate risk. At least price risk part of interest rate risk as the reinvestment risk. So when interest rates rise, bond prices fall. When interest rates fall, bond prices rise if they have a positive duration, and most bonds do have a positive duration. All right, so there's a definition of duration. Now let's talk about the categories. So again, you got to get the definition, then you got to get the categories, the subcategories. And under fixed income, there are generally three subcategories. There's short-term, which are low-duration bonds, intermediate-term bonds, and long-term bonds or high-duration bonds. The company Vanguard was the first company to come up with these designations for bonds: short-term, intermediate, and long-term bonds. Short-term bonds have the lowest duration, but remember they have the highest reinvestment risk. Long-term bonds have the highest duration, the highest price risk, but also will have the lowest reinvestment risk. All right, so there's your definition, your subcategories. Let's get a little bit more into this definition and look at some examples. So you saw this that I just gave you, so let's look at an example. So this is the exact same thing from the previous slide. So let's look at an example. So if a bond has a duration of 5 years, you would expect that interest rates rise 100 basis points. And let's talk basis points here. Here's another thing that they will expect you to know in finance. So if you're not familiar with basis points, learn it now and learn it forever. We will talk some about this. I'm sure I talked about it in the second class, and we'll talk about it more. You definitely need to understand it for paper 1. But a basis points is 1/10,000th, 1 over 10,000. So if you want to know what 100 basis points is, you take 100 and divide it by 10,000, and that gives you 1% or 0.01. So just divide by 10,000. So 50 basis points would be 0.5% or 0.005. 200 basis points would be 200 divided by 10,000 or 2% or 0.02. So if you have a 5-year duration and you expect interest rates to rise 100 basis points, that's 1%. So you take minus duration. Duration is a positive 5 times an increase in interest rates. I said interest rates rise, so plus 0.01. That formula will give you negative 5%. So what that means is if you expect interest rates to rise 1%, so interest rate go from say 2% to 3%, you would expect this bond fund or this bond to lose 5% in price if interest rates rise 100 basis points. If you have a bond with an 8-year duration and interest rates rise 200 basis points, you have minus duration times 0.02, or this bond would actually fall 16%. What if interest rates were to fall 150 basis points, were to fall 150 basis points, you have minus 8 times minus, because they're falling, 0.015, that gives you a positive 12%. I'll show you this a little bit more after we talk about convexity, or when we get into convexity. There's a spreadsheet I can show you and a website I can show you that really do some interesting things. All right, so I'll put this up here so you remember the formula, and then I'll show you some examples. You might put examples in your exam answer, but make sure you understand this. Do not memorize this for this class or for this exam. This is something you are expected to know when you interview for jobs, so just learn it permanently. It's an extremely important part of finance. So in general, the yield curve, and the yield curve is a list of all the different bonds at different maturities, is upward sloping. You should have gotten this in your first finance class when we talked about interest rate theory. So longer term bonds tend to have higher yields, higher interest rates than shorter term bonds. So when you take on more price risk, you have more duration, you're usually getting paid more for it. You're getting a higher expected return. You have a higher yield. Here's a website that shows you interest rates for the Treasury. So let's click on that. So here's that website. Let me blow it up a little bit. So this is a very unusual Treasury yield curve, but here's the 30-year Treasury. It's at 1.43%. The 1-month Treasury is at 0.12%. Not even much less than 1%. What we're talking about an upward sloping yield curve is you notice as you go out in time, interest rates generally get higher. Now you can go back in time if you'd like to. We can go back to say 2007. Like you look at May, you'll notice that the long-term rate, 4.8%, is actually lower than the short-term rate. And you'll see that in a few places. Over here, 4.83 versus 5.19. Now, have you heard of that term inverted yield curve? Inverted yield curve means long-term rates are lower than short-term rates. When does an inverted yield curve happen? Usually about a year or so before a recession. And we know in 2007, that was about a year before a major recession in 2008. So this website can give you some history. So you go to today. And you notice that the 10-year treasuries, this is the 10-year treasury here, the third from end is only 0.55%. Even the 30-year is just barely above 1%. And the short term is 0.1. Why? Because when COVID-19 hit and we had the economic shutdown, the Federal Reserve started cutting interest rates pretty dramatically And so you can notice just in a few months, and in fact, if you go back even to just the March, when we're in the middle of the COVID, interest rates got really, really low. I forget how low the 10-year Treasury got, but it got really, really low during this time. We're at one of the lower points right now. Interest rates are really falling. It's pretty unusual. If I had seen this when I came out of college, it would have made no sense to me at all. When I came out of college, these long-term treasuries were like 14, 15%. Short-term rates were over 10%. It was just crazy. And even 10 years ago, these numbers would not have made sense to me, how low they are. So we're in an unusual period of time. The 10-year Treasury had never been below 1% in its entire history until this year. And you can see most of the last several months, the 10-year Treasury has been below 1%. So this is a good place if you need to take a break, hit pause right here. We're about a third of the way through the class. Go get something to drink, something to eat, and we'll talk a little bit more about duration, and then get into a really fun topic, which is convexity. All right, so if you took a break, now you're back, and so we'll finish up duration. Remember, duration, we defined it. Duration is the weighted average time to maturity using discounted cash flows as our weight. It's a measure of interest rate risk or price risk of bonds. So a bond that has more duration has more risk. A bond that has less duration has less risk. We also talk about the different categories: short-term bonds, intermediate-term bonds, and long-term bonds. So now we'll talk about your tactical allocation moves. So this is probably the most important part. This is the application. So let's take one scenario. Your boss believes interest rates are going to rise significantly over the next year. What do you want to do? Maybe you think the economy is going to be strong, or maybe inflation is going to happen, or both. If you expect interest rates to rise, you want to shorten duration, because remember, it's minus duration times the change in yield. So if you have a long duration like 8 years and rates rise, remember when I said when you had 8 years and interest rates rise 200 basis points, you can lose 16%. If your duration is only 2 years, interest rates rise 200 basis points, you only lose 4%. So you can see you want to shorten your duration to reduce that price risk and be more conservative. Now remember, when you do that, because the interest rate curve is usually upward sloping, when you sell longer term bonds and buy shorter term bonds, you're giving up some income. So right now with longer term bonds, you're making 0.6, 0.7%. Short term bonds, you're making 0.1%. So selling those longer term bonds and moving the shorter term bonds, you're going to give up, your income's going to drop more than in half, but you're willing to do that in order to protect yourself from that huge price risk. Example of a tactical move is your boss believes interest rates are going to fall dramatically over the next 12 months, maybe because she thinks there's going to be a recession. Then you want to lengthen duration. You want to go out further on the curve, because if interest rates fall, remember that 8-year bond duration portfolio, and I said interest rates fall 150 basis points, then you want to go out further so you get more price appreciation. You see that bond will rise in price, and it makes sense, right? You have some bonds that are paying you 6% or 5% for 10 years. I'm not doing that today, but during my career, that was pretty common for longer term bonds to pay 5%. And you think interest rates are going to fall to 2%. You want to lock in that 5% and buy a longer term bond. And so that's the tactical. So take a second and think back through the 3 components of your answer to this, not just for our exam and for this class. Who cares about grades? We're talking about your career here. What do you need to know about duration? Know its definition, know the 3 categories, subcategories, and then have this tactical move. What do you do when interest rates are expected to rise? What do you do when you expect interest rates to fall? Now, last class I talked about Bruce Tuchman's book. He gets a little bit more specific than that, because interest rates don't just rise and fall. Sometimes long-term rates rise a lot, where short-term rates rise a little. Sometimes long-term rates rise a little and short-term rates rise a lot. So the yield curve can actually shift from steep to flat to negative, inverted to normal. They can jump all different directions. And so in Bruce Tuchman's book, he will talk about what strategy to use if you think rates are going to rise, but short-term rates are going to rise faster than longer-term rates. So here I'm keeping it very, very simple. One thing we do need to know when we get, especially when we get the credit, it'll be a little bit of time before we get the credit, maybe next class, we'll see. But there is a relationship between interest rates rising and falling and the economy, and I kind of show it here. Rates tend to rise in a strong economy, and interest rates tend to fall in a weak economy. We saw that when I showed you 2007. Interest rates fell dramatically from 2007 to 2008. We saw it this year with COVID-19. Interest rates have fallen dramatically from the end of 2019 into March and April of this year. So very important page. This will help you a lot in getting the answer on question 1 of the exam, but also especially question 2 where we talk the tactical allocation. What is your boss telling you? Are rates rising or falling? If they're rising, you want to shorten duration. If they're falling, you want to raise duration. Just think about the power of knowing this in the interview. So you go into an interview and they ask you for your view of markets, and you say, you know what, I think we're going to come out of this recession strong. I think interest rates are going to rise. This is the time I want to get into stocks and shorten the duration of my bond portfolio. That would be a very strong, sophisticated answer. And we'll practice this more and more and more. If it's still new to you or having trouble really fully grasping it, don't worry. We'll get into it more. All right, so let's get into convexity. Boy. All right, so convexity, the C of DC in DC cuts I. I love this topic. It is a tough topic. So what I'm asking you to do here is do your best to understand this is at a high level. I don't think it's that complicated at a high level. It is very complicated when you really get into it. So let's start again with the definition, the different categories, and then the strategy, those same 3 things. So the definition, convexity is that second order change in the price of a bond due to changes in interest rates. So bonds don't change in a straight line. They're what we call convex, and I'll actually show you that. They don't change in a straight line. If you look at the duration formula, it implies bond prices change in a straight line, and I'll actually show you here real quickly, right now. I have an Excel spreadsheet that I've put out there on Blackboard that you can use that does all this math. And I had a former student who actually built a web page for me using my Excel spreadsheet and doing this. I want to show you that spreadsheet here, that website here. All right, so here's this spreadsheet. You can change these numbers. I made this a 10-year bond, and he allows you even, you can do it with a little cursor there. The coupon, you can change the coupon around. I'm using a 5% coupon, a 5% yield. We'll talk more about this. All of these calculations are in the spreadsheet. So if you want to see the formulas, the formula for convexity is quite complex and quite difficult. So it goes on forever. You have to take all these numbers and put them together in a way. It's just really quite complex. Here's the duration. We'll talk more about duration. It's the weighted average time to maturity. You can see the weights here. So we'll get into that. I'll show you that when I show you how to do this spreadsheet. I will not show you how to do convexity, but you can look at the formula yourself. And here's the output. So let's look at the output. So this green line is how the bond price actually moves. This blue line is how the bond price moves if all you use was the duration formula, that minus duration times the change in yield. So we start at 0.0, interest rates are 5%. So here's where interest rates are 5%. What if they rise 200 basis points? What if they rise 400 basis points? What if they fall 200 basis points? What if they fall 400 basis points? And you can see these bonds have what we call convexity. Convexity is that curve that you get. And this bond has positive convexity. What that means is its bond price actually does better than what duration represents. So the difference here, because the green is much better than the blue in all cases, whether rates fall or rise, the green is higher than the blue. That's positive duration. What you notice, if interest rates don't move much, duration does a pretty good job of forecasting the price of that bond. You can see here at 200 basis points, duration says the bond price would have fallen from $1,000 to $844. Whereas the real bond price would have been falling from $1,000 to $859 or $860, so pretty close. But when you get out on the edges, you can see there's a much bigger difference in the two prices. So this bond has positive convexity. Its convexity is a hard number. Its duration 7.79, so it's a 10-year bond, but you see its duration shorter. Why? Because you're getting all of these coupon payments over the 10 years, and that shortens the duration. Let me click back on the output. Now let me change this to a 30-year bond, and let me give it a 0 coupon and a yield of 5%. What do you notice about the convexity here? And look how convex this bond is. Pretty amazing. Duration would actually show the bond price going negative, which is obviously not going to do that. And so the duration formula is really limited. If interest rates change a lot, duration really is wrong. And you can look here, it's really, really off. And look at the convexity on this bond. It's over 900. Remember on the 10-year bond, the convexity was 78, but with a 30-year bond and 0 coupon, the convexity goes from 78 to 901. This bond has a lot of convexity, which is a wonderful thing. So think about 2008. Interest rates fell, and if you had a long-term treasury, it didn't just go up in price, it shot up in price. Long-term treasuries were up like 30-something% in 2008 because they have so much positive convexity. So that's the definition of convexity. You can play around the spreadsheet if you'd like. I mentioned in last class the Frank Forbazzi book, The Handbook of Fixed Income. In that book, they go in a lot of detail on duration and convexity. So there's another way you can learn this. And there are plenty of websites that you can go to help you with that. So take advantage of this. Look at the spreadsheet I give you. Look at this one. Do some playing around with the numbers just to understand how these bonds behave under different interest rates. So let's get a little bit more into this. Okay, so this is going to get complicated. Get ready. But you should be excited because it's knowing the complicated stuff is what gets you the good jobs. If all you do is learn the easy stuff, everything else, if you only learn what every other finance major learns, then you have no competitive advantage. So I'm about to show you something most finance majors, undergraduate, never see, never learn. So we do have a class on fixed income now that they will cover this if you can get more advanced in this topic. But some bonds have what we call embedded options. What is an embedded option? An embedded option provides the borrower the right to pay off the loan early. They can prepay the loan before maturity. That includes callable bonds and mortgage-backed securities. So a callable bond is when a corporation borrows money and they have the right to pay the bond off early. When would they do that? Well, if they borrowed at 7% and now interest rates are 4%, they'll go out and borrow money at 4%, pay off that 7% bond, and they'll save themselves a lot of interest. You as the lender, you loan them money at 7%, and now they're paying it off early. When interest rates are 4%, you're pretty upset. You had a bond paying you 7%. Now you get all your money back early. What are you going to do? You have to reinvest at 4%. You're pretty upset. So when will the borrower execute this option to pay off early? They're going to execute it when it's in their benefit, which means to you as the lender, it's to your detriment. So the lender hates these things, these embedded options, because they're only executed at the detriment of the lender. It's the borrower's option, and they'll only execute the option when it's to their benefit. Mortgage-backed securities, these are just a collection of mortgages. We'll talk a bit more about this, but you know, with a mortgage, we've been seeing the commercials. I've been seeing them all over the place, encouraging people to pay off their mortgage, refinance their house. So you got a mortgage at 5%. Mortgage rates fell down into the 3% area, I think even below 3% in some cases. My word, take that 5% mortgage, refinance it at 3%. You'll save yourself a lot of money over the life of that bond. So this is where it gets complicated. These type of bonds, these callable bonds, these mortgage-backed securities, they're essentially what we call a straight bond. A straight bond is a bond that does not have the option. And then they're actually selling a call option on interest rates. We'll get into options later in the class, but you can see how complicated fixed income securities can get. So it's like you're buying a bond and selling a call option on interest rates. That is a very complex transaction. And I say that because I know some of your grandparents might be buying these securities in mutual funds, and they look at them, they look very low risk because they're highly rated. They're probably AAA rated securities. And they're thinking, wow, I'm getting a really good yield, I'm getting a really good return, and I'm taking any risk. But the only risk they're looking at is credit risk. They don't realize these bonds have tremendous interest rate risk. So the borrower will only execute this option to repay the loan if interest rates have fallen and they can refinance at lower rates. So when you sell an option, so you as the investor, you're lending someone money and you're selling them an option. What does that mean? You're getting a higher return. How do options work? Well, options rise in price when interest rate volatility rises. So interest rates become more volatile, the call option price rises. But remember, you're selling the call options. So you're buying a bond, which means you're loaning someone money, you're buying the bond, and you're selling the call option. Your worst case scenario is when interest rates get volatile because you're selling the call option price goes up when interest rates get volatile, which means something that you sold is going to go up in price. That means the net of your straight bond and the call option is going to go down in price. That is, these type of bonds, callable bonds and mortgage-backed securities, they fall in price when interest rates are volatile. So if you expect interest rates to become volatile, these two bonds, callable bonds and mortgage-backed securities, are terrible investments. Let's get a little bit more into it. There are convertible bonds as well. I'm going to entirely ignore convertible bonds. My guess is the fixed income class that we now have, which is a class I highly recommend finance students take, they'll probably spend some time on convertible bonds. I don't have experience with convertible bonds. We never did them at UTSA. They're quite complex. There is a really interesting strategy. It's called a convertible bond arbitrage that hedge funds do, and we'll talk a little bit about that a little bit later. But I'm going to ignore convertible bonds. But convertible bonds are bonds that can be converted into stocks, into shares of stock. But we talk about callable bonds. Callable bonds allow the borrower, so if you lend money to Exxon Corporation and it's a callable bond, they may pay you 5% for 10 years. However, they have the right after some lockout period that they can repay that bond early. And if interest rates have fallen, they'll probably do it. And they'll know whether to do it or not. There's a term you can look up here, and I'll give you some terms really related to this. But in your notes, right next to this, I want you to Google the phrase yield to worst. Yield, Y-I-E-L-D, to, the word to, T-O, and the last word is worst, W-O-R-S-T. You may have heard of yield to maturity. Yield to maturity is essentially the return you expect on the bond. But on a bond like this, your yield to maturity, you may not receive it. Because if the interest rates fall, they will repay the loan early and you will not get that return. And that is what yield to worst is. Yield to worst tells you what is your yield if this callable bond prepays at the worst possible time for you as the investor. So the yield to worst will always be lower or equal to the yield to maturity. But look that term up, Google it. I like Wikipedia. You can use Investopedia, but I like Wikipedia. I know professors are not supposed to use Wikipedia. I've yet to see a deceptive or poorly written Wikipedia page on finance. Whoever's writing those financial entries, they're doing a great job. So try that. Yield to worst. Look that up. You'll see a big discussion on callable bonds and exactly what that means. So why would you do that? Why would you take such a complicated term and look it up? Well, it separates you from the competition. You know something that most students do not know. All right, let's get the mortgage-backed securities. So this is a great term. I may have to tell y'all the story, my mortgage-backed security story at UTSA. If I have time, I will. I don't know if I want it on a video that's on YouTube, but it's a true story, so don't worry about it. I don't have any confidentiality agreement with anybody, so I might tell you the story. But let's first figure out what these things are. So mortgage-backed security is a type of asset-backed security, ABS. If you're not familiar with asset-backed securities or mortgage-backed securities, Google those terms and get the definition. But essentially, banks have loans on their books. They're very, very illiquid securities, or very, very illiquid assets. They're not securities. They're illiquid assets. But banks don't really want these loans on their books because they might have a mortgage that's a 30-year mortgage. Well, banks have savings accounts, checking accounts, certificates of deposits that are 1 or 2 years. Their liabilities are very, very short term. They do not want long-term assets. They go out 30 years. So what banks do is they take all of their mortgages, their credit card loans, their auto loans, but here we're specifically talking about mortgages. They take all of those mortgages and they put them into a trust, and that trust borrows money on the capital markets. It's an actual security, and what that trust does is it passes through any of the cash flows the banks get from their loans. So these are also known as pass-through securities, mortgage-backed securities, asset-backed securities. So asset-backed security is the larger term. It's the bigger concept. So mortgage-backed securities is a type of asset-backed security. Auto loan securities can be asset-backed securities. Credit card loans can be asset-backed securities. So essentially, a bank is taking assets off of its books and putting it into the capital markets and taking something that's very illiquid and making it liquid. If you want to talk about what happened in 2008 and why it was such a disaster, it really was this asset-backed security world, especially mortgage-backed securities. Securitization is also known as the shadow banking. It's where real banking is going. It's really shifted over to the capital markets. Banks really don't do these loans anymore. They're just like the middleman putting the loan together, and they sell it off to the capital markets. And these securities, especially the very low quality ones, those really blew up in 2008 in the financial crisis. But banks put all these securities in a trust. Now, when I worked at USAA, I worked next to the department that did this for USAA. USAA had a very fast-growing bank, and it's still fast-growing today. And it had a lot of mortgage debt and auto loans and credit card loans. They did not want those on the bank's books because the bank was growing so fast it was causing problems for USAA. USAA used to be an auto insurance, a homeowners insurance company, but it was becoming more and more of a bank. And rating agencies do not like banks, so USAA needed to get these loans off of their books, and so they were securitizing billions of dollars of loans all the time. USAA would have been a massive bank in size if they had not securitized all these loans. In fact, USAA was one of the first banks to do a securitization coming out of the 2008-2009 crisis. USAA was one of the first because USAA is a very high quality, very highly respected bank. They were one of the first ones to go into this market after it had frozen at the end of 2008. So that's what a mortgage-backed security is. So it's going to do whatever the mortgage holder does. The person who borrowed money on a house, if they want to prepay that debt, they want to refinance their mortgage, that's going to go right through this securitized asset, this asset-backed security. So if you own this asset-backed security, you are going to notice you'll get a lot of cash flow in years when interest rates are falling. At a really bad time, right? You don't want to get a bunch of unexpected cash flow to reinvest right when interest rates are at their lowest. So that's that kind of reinvestment risk as well. So mortgage-backed securities is an asset-backed security with very low convexity. I cannot show you a mortgage-backed security on that website we were just in because it doesn't have mortgage-backed securities built. They're very complex securities. But they would actually, you remember that 30-year zero coupon bond had a convexity of over 900? Well, mortgage-backed securities can actually have negative convexity. What that means is, you remember the line with the blue and green line where convexity had the price always higher than duration? Well, with mortgage-backs, especially when interest rates fall, their price is actually lower than what the duration line would have. Why? Well, because as interest rates fall, borrowers will refinance, and instead of your bond price going up to 110, 120, rising in price, instead the borrower pays you 100. They pay you exactly what they borrowed. And so the most you can get is to face the maturity value of the bond because they're going to pay you that. That's the wonderful thing about being a mortgage-backed, having a mortgage, is you can refinance your debt anytime you want to without really much of a penalty. There are some costs because you have to do you might have to do an appraisal, or you might have to buy some trust insurance, but essentially it's almost a free transaction. So what happens when you? So you might ask, why in the world would I ever lend money in these type of securities? If I don't get any of the upside, I just have the downside. When interest rates fall, instead of my bond price going up, I just get my money back at par. But when interest rates fall, when interest rates rise, I lose money just like when any other bond. Why would I ever buy this bond? So you can see interest rates fall, borrowers refinance, so my price doesn't rise much. When rates rise, borrowers actually hurt you by making fewer extra payments, so your bond price actually even falls more than you would think. So you have what we call prepayment risk, extension risk. Why would you lend money here? Well, because of this optionality, you're actually getting a higher return. You're getting paid an extra return to induce you to make these loans. Now, the last time I saw this, so don't quote me on this number because it's probably several years old, but I saw a study that showed that typically when people have mortgages that they can prepay, which is the case for all mortgages, they end up paying an extra 0.25%, an extra 25 basis points on average. Now, that number can move all over the place, but on average, they pay an extra 0.25% for that right to prepay. So that means if you buy one of these securities, you're getting an extra 0.25% return for doing it. So you're induced to do it. So you have to ask, do I want to try to get the extra 0.25%, but at the risk of prepayment risk or extension risk? Is that extra 0.25% worth it? All right, so here's another term you can Google to give you more information on here. We're getting pretty advanced here. Option adjusted spread. So what is option adjusted spread? Well, I just mentioned the 25 basis points. The 25 basis points is what we call the option spread. That's the extra return you get because you're providing the option to prepay the bond early. All right, let this sink in. You may have to watch this part of the video over a few times and read up on it. So what is the option adjusted spread? It's the spread where if you take out that 25 basis points. So the spread is how much return you get on the security over treasuries. Treasuries are the risk-free asset. So the spread is how much extra return do you get over treasuries. But the option adjusted spread is only the spread related to credit risk. So you get 25 basis points or 0.25% for the option part of the bond. And then the option adjusted spread is the additional spread that you get to cover you for credit risk. All right, so this is a good time to take a quick break, hit pause, finish Convexity today. We'll get a little bit further, but maybe take a break, maybe pause, maybe even go back and re-listen to some of this. This is pretty tough stuff I'm giving you, but then I'm going to show you a Wikipedia page on option adjusted spread so you can see what's in that page. So hit pause right now and take a quick break. So here is the Wikipedia page on option adjusted spread, and what you will notice right away is it has mortgage-backed securities in there. It also has a term, remember, embedded option. It also talks about the option interest rate risk. So it even talks about callable bonds. So you can talk about them here. There's basis points. 1 basis point is 0.01% or 0.0001. There's convexity right there. See how option adjusted spread is in there. So what is option adjusted spread? It's the spread that you're getting over the risk-free security. So if you have a 5-year mortgage-backed security, if its option adjusted spread is 5 basis points, you're getting 5 basis points over a 5-year treasury or whatever treasury the benchmark is. I should be careful in telling you that. You can see it actually goes in quite a bit of detail. It actually goes into some concepts that I haven't seen in a long time. I'd have to go look them up. Even talks about interest rate caps and floors. So the Z spread, all these kind of things in here. So you don't necessarily need to read all of this, but expose yourself to some of these complex topics, or take the bond fixed income class and really get into this. I think Dr. Baynot's teaching it this next semester. Really great stuff. And one of the reasons I want to whet your appetite to these types of ideas is so many finance students, they only think about stocks. I want to be a security analyst, and they think, I want to watch the stock market. I want to trade stocks. And I just think the bond market is just as exciting, and in fact, it's much more quantitative. If you really like math, if you're good at calculus, you like advanced math, you want to take some, and you're really good at programming as well, fixed income will pay just as much as the equity side, but there's more opportunities for you to distinguish yourself because there's much more quantitative. You can really take some more advanced mathematical classes and make yourself, boy, you'd have a career set in fixed income. So I just open up your mind to think a little bit outside of just stocks. You know, most students is either stocks or real estate. It's like bonds don't even exist. But you might say, well, you're discouraging me, Professor Sweet, because this looks complicated. But don't think it in those terms. Think it in terms of you've got a job, you're going to spend 50 hours or more a week. You're going to learn this stuff. And if you take a job that exposes you to really complicated stuff like this, you're going to lose it. You're going to learn it. You're not going to lose it. You might lose it the first week. You're going to learn it. You're going to become better and better at it. After a year or two of that, you can name your salary. So I encourage you, think in terms of complexity. That's what we pay. It's got to be useful. It's got to be something the market wants. But complexity, you get paid more for the more complexity you're willing to stomach and learn. That's why I tell students, if you're offered 3 jobs and you're not sure which one to take, it's easy. There's 2 criteria. You take the one that scares you the most, and you take the one that makes you move the furthest. Those are the 2 best criteria. All right, so let's jump back to the PowerPoint. So there's option adjusted spread. Here's just a few numbers. So let's say you have a mortgage-backed security that has a yield of 4.5%. But if it didn't have this prepayment, if it didn't let you prepay, it would only be giving you 4.25%. So there's that extra 25 basis points you're getting because of the optionality. A comparable Treasury has a 4.1% yield. All right, see if you can figure this out. So the option adjusted spread is 15 basis points. It's what the bond would yield if the option wasn't there minus the risk-free rate. And you get an extra 25 basis points for that optionality. That extra 25 basis points that you're getting is going to fluctuate around depending on the volatility of interest rates. When interest rates are really volatile, that 25 basis points will rise dramatically. When interest rates are very stable, that 25 basis points will fall dramatically. So 25 is the average over time. The OAS, option adjusted spread, is paying you for credit risk, and the 25 basis points is paying you for allowing the borrower to pay early. So that's really key in understanding these bonds. Let that sink in. So the degree of optionality in a bond can be measured by its convexity. Bonds with a lot of optionality will have very low or even negative. So all right, so remember the 3 things you need. The first one is the definition. We defined it. The second thing you need are the subcategories, and there's only 2 subcategories with convexities. They're bonds with positive convexity. That's those straight bonds, the bonds that have no optionality, and they're bonds with negative convexity. Those with embedded options like callable bonds and mortgage-backed securities. They have low or even negative convexity. Those are the only 2 categories. Now we saw with the positive convexity, there are going to be different levels. There are going to be bonds with extremely high positive convexity, and so like the 30-year bond. So generally bonds with a lot of duration also have a lot of convexity. So our focus right here are bonds with embedded options. So tactically, what did we say? It all comes down to the volatility interest rates. So if you expect interest rates to be more volatile than expected by the market, that's real critical. That 25 basis points is going to be driven by what does the market expect. So if the market's expecting interest rates to be very, very, very tame, but you expect them to be very volatile, you want to say what we have here is buy convexity. What does that mean? You want to buy bonds with high positive convexity, like non-callable bonds, like not mortgage securities. You'd rather have treasuries. All right? However, if you expect, let's say interest rates are really volatile today, but you expect them to become much more stable. The second one here. You want to do, I'm going to give you a really complex term here. You want to sell convexity. Now that doesn't seem to make much sense. You're not actually selling anything, but it's a fancy term. If you bring this in an interview, they'll probably hire you in a second because it sounds pretty complex. But you want to sell a convexity. What does that mean? That really just means you want to buy bonds with low or negative convexity. Why? Make sure you listen to this part right now. It's really important. The reason you want to do this is because these bonds have that extra starting yield, that extra 0.25%. You're getting that extra yield. If those bonds did not have that extra yield, you wouldn't buy them even if you thought rates were going to be stable. You buy these bonds for that extra yield, and then you hope interest rates will stay stable or get more stable. And that's what you're really hoping for these bonds. So you want to sell convexity, which means you want to buy bonds with low or negative convexity. So you want to buy mortgage-backed securities when you think rates are become more stable. You want to avoid mortgage-backed securities when you think interest rates are going to become more volatile, especially related to what the market is pricing. So the market's going to price its expectations. The market expects interest rates to become more stable. It's going to reduce this option premium. If they expect they're going to become more volatile, they'll increase that option premium. It's really key. Let me tell you just my USAA story. So we got a couple of minutes here, and don't click off just because it's not related to grades, because this is a great story. But USAA used to have 60–70% of its bond portfolio in mortgage-backed securities. And I came into a job, I was just entry level, hadn't been doing finance very long on the investment side. I've been in finance on the corporate side, not on the investment side. And I came in and I thought it was incredibly risky for USAA to have so much of its portfolio in mortgage-backed securities. So I recommended that we go to zero. And the investment company had a fit. The president of the investment company, remember, I'm just a peon analyst. The president of the investment company wrote a letter to the board of directors of USAA telling them how stupid he thought I was and how crazy my idea was. I had no experience, and he was right. I had no experience. My entire knowledge of bonds came from that Frank Fabozzi book. It was all academic. And yet I'm recommending, here's this guy out of UTSA, has never traded a bond in his life. All he's done is read textbooks, and he's recommending we go to zero. My boss told me, my boss wanted to make sure anything went wrong, they would fire me and he'd be okay. So he didn't want his name in this at all. So he asked me to write a letter to the board of directors arguing my side. And this is the argument I made. These bonds are very dangerous when interest rates become volatile. And surprisingly, the president of the investment company was arguing the exact opposite. He was arguing these bonds are good when interest rates become more volatile. What saved my hide in this whole debate was one of the board members was an expert in this area. He knew, he could tell I knew what I was talking about, and the investment company president did not. They listened to me. In fact, that board member, he was red-faced. He came and talked to me. I thought he was mad at me, but he wasn't. He was mad because we were buying so much of these securities and it looked like we didn't really know what we were doing. The team they have after that was much more astute. The people that were buying these before had not had the textbooks that I had, all this stuff. These bonds have only existed since the early 80s, and the people who are buying these bonds grew up with bonds in the 60s and 70s. And so USA sold well over $10 billion in these bonds, got out of these securities. And boy, it's a good thing we did. A couple of years later, the rating agencies became very negative on these bonds, and they started downgrading firms that had heavy exposure. And by heavy exposure, I mean firms that had more than 10% of their portfolio in these bonds. They started downgrading them. USA had 60–70% of our portfolio in these securities. It's a good thing. Now, as a PR analyst, I got no credit for that, so all I can do is toot my own horn. But just to tell you, if you read this stuff, you get into it, you study for the CFA exam, you read the textbooks, you can add tremendous value to your company. These are complex things. Learn the complex. That's where you add the value. All right, so I'll stop it there with that kind of self-grandizing story. I did make a lot of mistakes at USA. I just won't tell you those stories, but I did have some really good successes as well. So great stuff here. That's why I'm so excited about this. Think about this and send me some questions. Watch this video a couple of times on the convexity side. Read some of the Wikipedia side and see if you can get some comfort with this concept, because boy, it will surely help you in an interview.